Okay, Assalamualaikum. This is a question to be discussed today is our question on February 2022. February 2022 is question 1 and we're going to go through the question, and then after the session we are going to look at how do we answer the question. But before that, let's go through the question. And the question is a question about a company called Marchunk. Yeah. It's a company that involved in varieties of drinks, manufacturing of drinks, and it is located in northern Malaysia. And the financial year end of Marchunk is 31st of December. Always take note on that year end. And the current financial year end is on 31st of December 2020, where you are given the trial balance. The company also give the date, has the date of the authorization date, and the authorization date is 31st of March 2021, the date where the financial statement were authorized for issue by the board of directors. As usual, before we look at the question, look at the requirement of what you asked to do. You asked to prepare again the statement of profit or loss and other comprehensive income. Other comprehensive income is normally related to the revaluation surplus, statement of changes in equity, statement of financial position as at 31st of December 2020, and the notes to accompany the statement, which is the capital commitment in this question. You will notice there is no contingent liabilities, and there was 430 marks. Like, let's look at the first situation that you have here is on the trial balance given to you. So if you look at the trial balance given to you, you have this item revenue. This is an income. It goes to the SOPL. This is an expense, cost of sale, only share capital, retained earnings, and ARR, asset revaluation reserve. This is the one going to equity. Be careful, the asset revaluation reserve is giving you the balance for the revaluation surplus of freehold land of 72,937,500. 100,000. So therefore, if you have any other initial revaluation, that was what happened and it was shown there. And if you read the question, you would notice there is another revaluation. So you be careful with the treatment of the revaluation for the freehold land in this question. And you also have the interim ordinary dividend. This is equity distribution, and that will appear in the statement of changes in equity. That was dividend for ordinary shares. And be careful if you have any final ordinary dividend in the additional information. Here you don't have. Your investment income is under your income, but that has a special line item for investment income. Admin expenses, this is expenses. Do not forget to include the other expenses there, but here you have one item, research and development. Research and development, you will learn this in detail under MFRS 138. So MFRS 138 is not covered in FAR270. And if you notice in research and development, if that met the criteria for capitalization, it will be classified as non-current asset. So at this moment, you will just assume that fulfill the capitalization requirement. So this will be capitalized. Unless you have detailed information about research and development, you may notice that research will be expense of. That will be covered in FAR 320. Interest on debenture, this is finance cost. I put here finance cost, FC, freehold land. And those items up until here, these are all non-current asset. Be careful with the accumulated depreciation with the negative non-current asset contra asset account to the PPE. That was the one beginning of the year. It is not the one at the end of the year. So current year depreciation has not yet been charged. Selling and distribution, this is expenses. Audit fees are also expenses, but be careful, selling and distribution are classified as a separate line item. Audit expenses are part of admin expenses. Bank and cash balances, be careful if you have any receipts or payments of cash and bank. So these are current asset. Inventory is current asset as well. Long-term investment, non-current asset. Sales commission is part of expenses, and this is going to be under selling and distribution. Tax paid expenses, be careful with the tax charge so that you will arrive at the correct tax recoverable or tax payable. Long-term loan from hutang bank, if you have no other information, long-term loan should be assumed as non-current liabilities unless stated otherwise that the loan is a short-term loan. A short-term loan may be classified as current liabilities. Allowance for impairment of trade receivable, you are not informed whether this one is at the end of the year, but this is a negative current asset, and that is actually the thing related to trade receivable. So you may have to go and check if you have any information on that trade receivable. If you have none, this is normally assumed to be at the end of the year unless there are any adjustments. So you may have to adjust to that carried down balance. Trade receivable and payable, of course, current asset and current liabilities. Okay, let's look at the first information. The first information is on the items on revenue. So you can see that I have already prepared some journal entry next to the question. So the first item before that, okay. Revenue above includes credit sales amounted to 1.2 million worth of goods which were delivered on 6th of January. Remember, the year end was 31st of December 2020. And the performance obligation, which is the delivery of goods, were only made after the reporting date. So if that is the case, right? If that is the case, this is not supposed to be recognized as a revenue. So the goods were included in the closing inventory. So this one is correct because you have not earned the revenue yet. So you cannot remove the closing inventories of the goods that you are selling. However, you have recorded the revenue, meaning that before this, you have already debited the accounts receivable and you have credited the revenue. What you need to do now is to do the correction, to the removal. Go and remove the revenue, debit revenue 1.2 million. You can see the answer here that I'm putting the answer here. You can see it next to the question. And you credit the account receivable. So when you debit your revenue, this will be adjusted in your SOPL. And when you credit your account receivable, this will be adjusted in your current asset in your SOFP. Do that later. Okay, done with number one. Number two. Number two is on information on PPE. PPE. You have information telling about yearly basis being adopted. For the depreciation on building was 5% on cost, and the depreciation on plant machinery was 10% on carrying value. Next. So let's look at this first. The first one. The freehold land was valued at 67.25. So the freehold land you have here, it uses the revaluation model. So it was valued at. So this one is the fair value. When was the fair value? The fair value on this 31st of December, the end of the year. So you don't have to go and adjust the depreciation whatsoever because this is non-depreciable asset. You are going to incorporate this into the amounts in the books because items here uses revaluation model. Measure the land on subsequent measurement using revaluation model. Meanwhile, you are also being informed that the item building was measured on cost model building. The machinery was also measured on cost model. So these two items are on cost model. So be careful with that in case there are any acquisition of building or disposal of building, acquisition of machinery or disposal of machinery. But lucky you today, there is no acquisition or disposal of machinery and even the building. So this is an easy question. So we just need to do the revaluation for land. So let's do the revaluation for land, which is the one here. Right. Before that, we do the depreciation. We will be doing the one for depreciation first, since there are no adjustment for the item except for depreciation. No adjustment for acquisition, disposal, write-off whatsoever, nothing. So we'll start off with the building. Depreciation of building, it should be done based on cost. So the cost is the one here, which is the one given here. 58,350. And that would be the one for building. The one for building is 58,310. I just change the color. It should be green, blue, yellow. So that times by the percentage, 5%, and this is to be done for 1 year. So it is 5%, 5830. So we have 2,917,500. That is the one that you will put in your admin expenses and credited to the accumulated depreciation. Make sure this is shown in your notes on PPE. The second one is for the plant and machinery. For the plant and machinery, you will have the machinery uses the 10% carrying value. Remember, it was not the same as for the building. Building is 5% on cost. So 10% carrying value means 10% on the value after deducting the accumulated depreciation. So if you calculate, you will take the cost, which is this figure, right? And sorry, the cost is the figure 41,192, and the accumulated depreciation was 3,997,500. Take that and then multiply with 10%, and here you will have 3,916,500. That was the depreciation that you will show under admin. Do not forget to show this where to in your notes. Show them in notes on PPE, right? That part, notes on PPE, and this part would be to show them where in the building, right? Building, which is show them in the cost, in the accumulated depreciation as well as in the expenses section. So accumulated depreciation is going to be shown in the notes on PPE, but the depreciation itself will be part of admin expense. Next one. Done with that? Do you have any question before I proceed with the next one, which is the revaluation? Do you have any question, class?
So far, no, madam.
So far, none, right? Okay. We go on with the item freehold land. The item freehold land, yeah, was revalued to 67,250. So that was the fair value. And we are going to look at what are the carrying amounts. Fair value is 67.25 million. So the carrying amount or the carrying value is given in the question because the whole building was being revalued. Whole land, sorry, not whole building. You can check, it was 67.4. So that was the figure. And there was a difference of how much? 150,000, right? Is it 150,000? The difference on the for the balance, you can see fair value was actually lower than the carrying amount. Fair value, that it was lower, so you can check here. 67.25. This one is 67.4, and therefore there is a deficit. How much is the deficit? Take this minus this. What is the amount?
150,000.
Okay, 150K. So out of this 150K, you have 150 deficit for the land. You need to go and check what is the asset revaluation reserve balance for that particular land. So you are given the balance brought forward. You can check in your trial balance. You can see that the accumulated balance for that it was 100,000. So for that 150,000, 100,000 should have been debited to the asset revaluation reserve. And for this deficit, which is the balance, remaining balance, which is 150,000 minus 100, you have 50,000. This one will be treated as where to? It will be treated as revaluation deficit, where it will be expense off to your SOPL. So this one will be reduced against the revaluation reserve balance, but the 50,000 will be expense off against the statement of profit or loss as revaluation deficit. You can see this in my journal here. Debit ARR land, I am taking the maximum amount the balance has, 100,000. And SOPL, the deficit here will be reduced against the admin expenses, 50,000. And the land, freehold land actually, the freehold land would be credited because there was a reduction in the value of the land by how much? By the item here is 150,000. There is no need for you to adjust for depreciation. So if you have done that, the effect will be here. Saya tunjuk sikit. I will show it here. Yeah. You can see for the item profit for the year here, there is none. Why there is none? Because that was not the current surplus here. You do not go and reduce against any, or the item does not relate to other comprehensive income, because deficit is not other comprehensive income. You reduce against the ARR balance, but the ARR land there is the balance from the previous year, so it will not be shown there, but the effects here is here. The revaluation deficit is under your admin expenses, the one here, revaluation deficit. So just put a color here to make things easier for you to locate. I put this color. Okay, so that was 50,000. And at the same time, the deficit that was reduced against the asset revaluation reserve are reduced in the statement of changes in equity. You reduce them in the statement of changes in equity. How much? You reduce by 100,000, the one that you credit to your asset revaluation reserve. So with that, you have these two items. The impact is here. At the same time, it will give impact to your statement of, to your notes on PPE. I want you to pay attention on this. You can see that I am doing this on purpose to show the difference between the two revaluation deficit. One is the one that was adjusted against ARR, 100,000. One is the remaining balance that was reduced against the as a revaluation deficit. That was the admin expenses, 50,000. Right, you can see that effect here. Or you can put the total 150. But bear in mind, you need to know which one is the one that you reduce against the ARR, which one is the one that you charge against the statement of profit or loss. Class, are you with me? Do you have any question on that? On that revaluation deficit for freehold land?
No, madam.
No. All right. We go to the next one. Then with that, we do number 3. Number 3. Number 3 is about this situation under MFRS 137. You have your customer took a legal action, so there is a present obligation, potential legal obligation here, legal action. So this, and then you, for the breach of contract that caused the customer loss. So the breach of contract is the past event that caused the customer to incur loss. The legal advisor of the company was in the opinion that the company will be held liable for the sue. So meaning that you are likely going to pay for that compensation. So this means that the outflow is probable because the opinion is your legal advisor's opinion. Hence, the company needs to pay 320,000. So he is in the opinion that the company will be held liable for the amount 320,000. So the reliable estimate can be made. However, no payment has been made as at 31st of December. The three criteria is fulfilled for provision under MFRS 137. So this is a provision for compensation. So you are going to debit the provision for compensation. It will be done here. Debit compensation cost, credit provision for compensation. You can see here 320,000, and this will be shown under other operating expenses, compensation cost, other operating expenses, and the provision for compensation that will be shown as current liabilities. Next one is number 4. Number 5 now. Taxation expense for the year was estimated to be 3.9. At the same time, number 4, there is one more that I have overlooked, which is the amount that was expected to be bad. This one, number 4. I have not done number 4. Yeah, I'm going to do number 4 now. Then 25th of September, one of the customer who owed Marchunk 150,000 went missing. Reminders has been sent, but the company was unable to locate or trace the customer. None of the amount was expected to be recovered. So that means that you need to go and write off this as bad debt. So this should be written off as bad debts. Written off. So when you do that, in number 4, debit allowance for impairment of trade receivable with the amount 150,000. If you are informed that 150,000 is the amount that were not expected to be collectible. However, let's say you are informed 70% of the amount was expected to be unrecovered. So if you are informed 70%, what you debit here, what you credit here is not 150. It should be 150,000 times 70%. But here, no information. So you assume the amount was 150,000. No further information to confirm on that. So number 5 now. So this one will be adjusted against our allowance for impairment in the current asset. Trade receivable also will be deducted with that. Bad debts written off. Number 5 is on tax expense. So that was 3.9. Compare that with the tax paid, which is 213,750, and the taxation was 3.9 million. So you can see that you have paid here the tax paid. Let me check the tax paid. How much was it? Oh, sorry. Tax paid was 3.6 million. I have overlooked that. It was 3.6, and the tax charge was 3.9. So the difference was 300,000. You have underpaid the tax, and therefore the difference is tax payable. So you can see the journal entry that I have put here, the one here. This one is tax payable, and that tax payable will be adjusted in the current liability. Next one is number 6. Number 6 is on 30th of November in the same current reporting period. Marchunk entered into a contract with XZZ Machines to purchase high technology machine worth 3.8. Meaning that you have not yet purchased the machine. This is like a so-called MOU that you entered in, or a contract that you sign only to purchase the machine in the future capital expenditure. And there is no future economic benefits expected to be flowing to the company yet as at 30th of November. So there is no cash that will flow or will involve in this transaction. However, this is a future capital expenditure, which is also known as capital commitment. So number 6, no journal entry. It was just a capital commitment. right? However, number 5 just now, there was another outstanding audit fees that were informed in number 5, this one, right? So make sure that you include that as your accrued audit fees. You can check the journal entry there, here. This is also for number 5. And for the number 6, there are no journal entry because this is just a capital commitment. You need to go and copy that sentence and put it under the item under your notes to the account. Next one, number 7. Number 7 is regarding your sales, where at first it was a credit sales, but somehow you have it was a cash sale, but you recorded as credit sale. This was the error. You go and debit your account receivable and you go and credit your revenue. This is what you do, right? So to correct the error, the account receivable is the error, the revenue is correct, right? So the amount is correct, 5,000. This is correct. So what you will do now is that you are going to go and correct the error. So the account receivable will be removed. You will credit account receivable with 5,000. And now the revenue, you don't have to go and adjust because that was correct. The revenue was correctly recognized. But you need to go and add to your cash. So debit cash because that was a cash sale, 5,000. So you go and recognize the cash receipt that you have not recorded. So that is what you have here, this item here. And this is going to be the one that you have to do the correction of 5,000, right? Make sure you go and add them to your cash, remove that against account receivable. So we are done with this. We can now prepare the statement. The first thing first, you can see that I start off with the revenue. So the revenue, you have to adjust with the one in additional information number 1. Remember, additional information number 1 was regarding the wrongly recognized revenue. So I put here revenue error. Next, cost of sale. Here there are no adjustment to MFRS 102 inventories. There are no adjustment. So meaning that the cost of the inventory here, which is 17,456,250, that reflects the cost of inventory. Which one? This one, 76,650 has reflected also the net realizable value, meaning that the cost of sale where the information on inventory was in the calculation of cost on sale. So no adjustment for that. Next one is admin expenses. You can see the column that you have here for admin expenses. As per the trial balance is the one here. Then you need to add up with your item like audit fees. Remember, audit fees as per here was 502,500, and your additional audit fees just now was 58,000. So you can see here the one that you have in the section here, 560,500, because the addition of the accrued expenses. Sales commission is under selling expenses. Depreciation, the calculation I've done that. The depreciation for machinery, I've done the calculation. Compensation cost, it will be under other operating expense. So I will just increase the size here so that easy for you to refer. Okay. Compensation cost, remember our entries that you have here. This one. Compensation cost, I put a color for you. Okay. So the allowance for impairment also was there. That is also adjusted under admin expenses if there is an increase or decrease in allowance. In our case, none. That it will not affect our admin expenses unless you have the impairment loss of accounts receivable. Here, none. So compensation expense would be here under other operating expenses. Finance cost 3 million. Where do you get this finance cost 3 million? This is actually from here. You have the interest on loan. Which one is interest on loan? Let me check. You have the long-term loan 9712. So the interest here, interest on debenture. Interest on debenture 3 million here. You cannot check the interest on loan. The reason is because the percentage is not given. You're not sure how much is the interest. It says maybe this is free interest, loan free interest, right? You're not sure, but you are sure with the interest on debenture to be 3 million. So that will be included here. Okay, so you are done with that. You will transfer all the item that you have calculated to the template. And the first item that you have is your profit before operation 64,202,500. The finance cost should be deducted. And by right, you should have put this correctly. Yeah. But make sure that you do it correctly. Okay, equal negative. It should be selling and distribution expense. This one, right? Okay. Okay, this one is going to be this figure here. And the other operating expenses is going to be this one. And the finance cost, this one here. Okay. Cost of sale. Right. So you have this figure here. It is 49.5 million. What's this? Investment income. Investment income 49.5. Where do you get this? This is from here. Okay, 49. Interim dividend do not include because interim dividend is not expenses. That was the distribution of your retained profit. So just focus on the expenses. Research and development, we will capitalize assuming it fulfills the capitalization criteria. So these are the things that you need to include. Sales commission, include them under your selling expenses. And the rest is all about the item in the statement of financial position. All right. So let's look at what you have here. Okay, your profit for the year. Your profit for the year should be how much? Have you done yours, class? So here is 49.5 and the one here is, let me just do the addition. Okay. There are no other income in this question. If there is, then you will be able to know. So what is your profit for the year, class? Class? Profit for the year. Do you get this? 57, 352. Do you get that?
Yeah.
Yes. So that figure should be transferred here, right? And now the workings are done. Let us look at the statement of changes in equity. For the statement of changes in equity, you are going to take this figure, this, and this as your starting point. So let's just start that here. Okay. I will just reduce the size. Okay, you can see the figure was taken from here. These three figures. And this is the total. Your revaluation deficit will reduce your ARR to 0. Your share capital does not change. Your dividend, interim dividend, will reduce your retained profits. This is the profit from last year. This is the current year profits. So you have the profit for the year, and here is the your balance at the end of the year for the retained profits. So these two figures, there are only one figure for the retained earnings. There are no figures for ARR. Why? You have fully utilized the ARR balance during the revaluation deficit before you charge the deficit to the SOPL as the expenses. Done with that. So that is the item that you will transfer here. These two items, one from here. You need to total up the item expense, the item, I got class, item expense, so you have to total up, sorry, the item reserve, no expense, sorry about that, I got some distraction. All right, so you have 213,143,750. Do you have question on that before I proceed?
So far tak ada. So far no, madam.
So far no question. Okay, good. Property, plant and equipment. So I will work out this for you later. I will just show the research and development. But this one, as I mentioned, we assume it fulfill the capitalization criteria for being shown as an asset. You will learn further next semester. Long-term investment, no changes. Bank, this 5,000 was due to the cash sales that was just being recorded. That now increased to 339,005 million. Inventory has no reduction since there are no adjustment. This one is, the first one is the revenue error. The second one is the item we have adjusted much earlier, 150,000. I think you are aware of this, allowance for impairment here. And the last one is item number 7 because of the wrongly recognized cash revenue as credit revenue, right? So those three items here, one is number 4, number 7, and number 1, the one that affect your calculation of trade receivable. Next one is allowance for impairment loss of trade receivable. It is 67,500 because previous balance was 217,500, the one here, this one. And you have written off the bad debts. The bad debts was how much? Was bad debts here, BAD, bad debts. Write off that. It was 150,000. So you have 67.5. So 21,295 is the figure coming from the deduction of this 221,362. So we have the total here. Reserve, these are from here, the two total here, but here none. And then the share capital is from the total here. Long-term loan from hutang, 972,500 here. Trade payable is the one that you have next to your trade receivable. I'm still looking for it. Where is it? Wait, yeah, I cannot find the trade receivable.
Here's the last one.
Oh yeah, thank you. I really cannot find it. Yeah, this one, trade payable, trade receivable. Okay, thank you. Next, tax payable, I've done that part in our last few journals, this part. Yeah, tax payable, 300,000. And You have your accrued audit fees. Remember 558,000 we did the adjusting entry. The provision for compensation and MFRS 137. And here is the total. This is the notes to the account. The one that you have here. You can see what you have here is four columns. One is for the freehold land, building, planetary, and the total column, right? The total column. But the revaluation, okay. Right? Next would be the deficit. You know the total is this total, but the point is we are looking at we're not going to prepare the total column normally. In exam, we just focus on the item. And then you have the total here, 67,250. The one here, no changes. No changes. Here, plan machinery also no changes. The only changes is on your freehold land. You just need to calculate the depreciation for plant machinery and building. At the end, you have 149,633, which is your item for your carrying amount, which is the one here. First, let us just work out. Yeah. This minus this, you got this. The last one, do you have any part that you want to ask? This is quite easy except for the revaluation deficit that you need to do adjustment. Other adjustment is very common adjustment. This one is the capital commitment that you have in the additional information. Okay, that's it. That was the end of the discussion. I hope you have benefited a lot from this.